thank you again for attending Building Wealth by Investing in U.S. Real Estate. So we've got Bronson Hill, which I met I guess a month and a half ago in Dallas. He's a fairly big syndicator in the U.S. And today we're just going to talk about using real estate as a hedge against inflation. I guess we're going to talk about interest rates too, because everybody's getting hammered a little bit with the interest rates right now. But welcome, Bronson.
Awesome. Good to be here. I love talking real estate, love talking shop. And I know that, you were explaining some of the stuff going on in Canada, just as far as getting Canadian investors in the U.S. I appreciate all the value you bring to everybody, trying to help educate as well as facilitate how people can get involved investing in the U.S. So excited to be here today.
Awesome. So do you want to start? You want to just start what you wanted to talk about? Why multifamily? Why using it to use it for, against inflation, I guess.
Sure. Yeah, absolutely. Yeah. So multifamily, I think there's some multifamily fans on here, but it's amazing how it performs during times of inflation, because there is a chart. I'll see if I can find the chart, but basically if you look at a chart of just trend line of inflation and, rents, they tend to basically go hand in hand. So this is what you can see right here, right? Is that this is the trend line from 1960 up to close to present day, not quite, but you look overall inflation, it lags a little bit with rent, but in general, it's a very correlated line. Well, why is that? It's because the more money that is created, the more it has to go somewhere, and it typically ends up in places like rent. So that's why multifamily, you look at this, it's pretty steady. Overall, you'll see, maybe some small changes in rent, but in general, it's a pretty upward trending line. So that's just kind of a quick overview on inflation. But the amazing thing about inflation as well when it comes to multifamily, let's say I buy a $10 million building, or you buy a $10 million building, and you have it leveraged where you have 25% down. So you're putting $2.5 million down. This is not uncommon in the deals that we do. I know a couple people on here are operators as well. And let's say the property value goes up by 25%. Well, a lot of people would say, how much money did you make? And you'd say, well, I made, 25%. And the answer is no, really, you made 100%, because you doubled your amount. So you're basically getting paid to take out leverage on a very stable asset that generally appreciates over time. Now, obviously, you don't want to misuse that. You don't want to do that incorrectly. You got to be aware of the risks and things like that. But to borrow, at least I'm going to share a lot of, U.S. numbers here, but we're still finding, mortgage and loan rates for multifamily apartments, even single family houses, that are around 5% or so, maybe less or more, but let's say it's about 5%. Inflation, the official rate is about 8.7% or 8.8%, but the unofficial rate is probably more like 15% or higher. Everybody's seeing much higher rents, and the governments like to have these inflation numbers be lower than they actually are. So if you're borrowing at 5% and inflation is, let's just say 10 to 15%, you get to pay back the money in future dollars, which are worth less. So not only are you getting cheap debt now that you can buy these assets with, but it tends to be worth much, much more over time. In the U.S., there's actually another chart I could show as well, but it shows that between February of 2020 and February of 2022, so over a 2-year period, the amount of currency, just total currency in the system, physical and money in bank accounts, it increased by 40.9% in the U.S. So that just means just all of a sudden they dropped all this new money in there. And what does that mean? That means that everything is going to cost more. Everything's going to cost more from rents. It's going to cost more from assets such as apartments or real estate. It's going to cost more as commodities and things like this. But a lot of times the blame is tried to be shifted to, it's Putin or it's all these other things. And there's some of that. Yeah, there's some supply chain stuff and other things. But when you create a lot of money, it creates everything just costing way more.
Awesome. So when we talk about inflation and interest rate, maybe, on question, let's talk about inflation and interest rate with the biggest hike that we've had in a long time. How do you see that affecting the markets, well, especially real estate, in the short term or long term? Because,
right.
We're reading reports, by 2024, it's going to drop again. And, it's just to shock the market. But what are your thoughts, and how do you see things going?
Yeah, and that really is the elephant in the room, right? That rates are rising. They're rising fast. I think it's the fastest rise they've had, over 25. They've been raising rates now, at least in the U.S. at 0.75%, this month. I think they're planning to do it next month. So they're raising them very fast. Typically, when they raise rates, it's typically slower over time. So like they're trying to kind of play catch up on what's happened with the interest rate. But my concern is as they raise rates very quickly, what could happen is that something breaks. And what I mean by that is that some sort of, maybe there's a certain group that depends on funding or financing. All of a sudden, they can't get debt that they need, or they can't get it cheap enough, and it causes some big pain in the economy. So the challenge of what we have right now is that we have so much debt in the system. We have governments that have massive, massive debts, just a very, very high percentage of GDP. And so when you have that, they have to have low rates so that the payments don't become unmanageable. The higher those payments are, the more they can really become unmanageable as far as managing the debt. So some investors are concerned right now because rates going higher, what does that mean? It means that more money goes to payments. There's some uncertainty. There's some expectation that rents are going to rise. We're basically in the U.S., we have these interest rate caps that you're paying money for. We were paying one price, which was pretty minimal before. So it would, if things went up a little bit, then you'd be capped. There'd be an insurance that would limit how much, if the insurance rate goes up, how much you'd actually be paying. Well, those prices on those have gone up something like 15 times what they were just even a few months ago, 6 months ago or so. So it's something that I would say there's kind of there's a plus and minus to everything, right? You have inflationary factors such as money printing, such as population growth. There's a lot of things that are causing, inflationary factors, but then you have things that are deflationary, such as a recession, such as interest rates rising. What does that do to valuations? Well, typically interest rates rising typically decreases valuations, right? It decreases valuations of multifamily or real estate in general. So it is something, we are concerned about, we are watching. Typically we'll have something that, we'll get, we know that our rate is capped for the next 2 to 3 years at around 6% or 6.5%, which are still very manageable for us. And then it's typically on average, if you look historically at the Fed, it's about 2 years is the average where rates are rising. Once they start raising rates, the longest typically is about 2 years. The longest they've ever done it for is close to 3 years, and then they start lowering rates again. So my thought is that they're going to raise rates for a while. I've heard even up until, the midterm elections, and they'll raise rates for a while, and then they'll probably have to start lowering them again. But it's just, yet to be seen, how serious do they want to tackle inflation? Because I think the more serious you are about tackling inflation, these government debts become really, really big issues for the system, and it can kind of destabilize the system in a way as well. So that's a very convoluted answer to a convoluted problem.
So when you guys are buying assets and so forth, because the buildings are worth less with interest rates going up, are you guys using that to kind of bet with that a bit, or how do you guys looking at stuff like that?
If we're buying interest rate caps, you said, we're using that to bid up prices of real estate. Well, I mean, in general, what's happening right now, we have 3 deals under contract. We have one that's closing this week. We've got one that's closing in a couple weeks, and then one that we're just opening up. And we're finding that people are actually, the word retrade is kind of a bad word in real estate in the U.S. It means basically you've agreed upon a price in a contract, and you have to go back and say, hey, we said we'd pay you this much, but we really want to pay you less. And so some of that is starting to happen a little more, where there's some renegotiating happening. And we've seen some people have actually walked away from deals that, they have $1 million hard, which means the money is non-refundable, and they have $1 million. Let's say it's down on a $50 million deal, and they've decided it's less work just to walk away from the money than it is to try to pay and close the deal. So we're seeing, there is some negotiating happening between buyers and sellers. Obviously, the lower the rate, and this works with single family as well, that the lower the rates are, the more people can afford to pay for a house, right? If your payment, how much you make, if you get a really low rate, and it's the same with multifamily, right? We know that when rates are low, asset prices can go higher. One thing we try to do to hedge really against that is we try to buy in markets where we see a lot of population growth. We're seeing business-friendly, landlord-friendly. The area we buy in a lot is Jacksonville, Florida. We love that market because it's a mid-sized market. You can still buy for about $300,000 US. You can buy a decent house, and it's about 97% occupied there. And of course, it's Florida. Who doesn't love Florida? You can have a pretty good life in Florida if you work remotely or if you're a retiree. And for every person that moves there, particularly retirees, they need healthcare. They need, people cleaning the house. They need retail. So I think there's things that you have to look at beyond just, okay, what's happening with the rates and what does that mean for all of real estate, right? It's very central to to different markets. Whereas I think a market like Jacksonville, we even saw this in Texas, pretty much all over Texas in 2008 to till now, is that Texas just boomed, right? Because it was business friendly, because businesses were moving from California, where I live, or moving from New York or wherever, moving to these cheaper areas because labor was cheaper, housing's cheaper, and people had a better quality of life. So I do think some of those things are going to continue. But again, it's when you weigh out kind of where's the risk there, right? There's a risk in every deal. So where's the risk? And if rates go up, what does this look like in a few years when those caps are done? Those are all important things to be able to try to consider.
Awesome. So, when we talk about inflation, materials have gone up, maybe like, what are you guys doing to kind of counteract? Because right now I keep joking around that what's a budget these days? It's like, we can't respect our budgets, even though you're putting 10-15% contingency, it's hard to get the numbers. It's like a yo-yo. It's a big time yo-yo right now.
Yeah, I have friends. I was with Ken McElroy this last week, who's a big time multifamily guy. I was $1.5 billion in real estate and author of books, and he of many books. And he was just saying, like, construction is getting much tougher. And he was kind of at the place of, we can do construction and build cheaper than what it costs for some of these existing apartments in Phoenix. So, for example, if it's $300,000 for an Class C apartment, a working class apartment in Phoenix, you can build them cheaper than that. But he's kind of gone away from that, saying now there's too much uncertainty with especially new construction of knowing what things are going to cost. So for us, I guess the saving grace that we found is that in general, if we have some in-house teams or people that are doing renovations, it's typically, I wouldn't say it's not as hard. Things cost money, but we are putting contingencies there. But we realize rents are also continuing to go up. One example of this, we're seeing, stuff we're buying at $900 a month in average rents. We're seeing, we kind of projected to get to about $1,350 in the fall. Well, we're seeing those rents going for close to $1,500 now, right? So costs are going up, but rents are going up as well. So as long as you're really able, there's two sides of the equation. One is the expense side, the other is the income side. And you just have to figure out what sort of uncertainty you want to, what kind of risk you want to take. The longer the time horizon, meaning if you have a new construction and you're looking at building something ground up, you have a lot more time risk. You have a lot more risk of not knowing what the market's going to look like in 2 years versus, hey, we can come in, this is a vacant unit, and we know in 2 weeks or 3 weeks, we can turn that apartment, we can come in, we can do the floors, the walls, we can do some upgrades, maybe spend $5,000 or $10,000 on it, make it look really nice. And we know we can see that upside in the rent, right? So, but it is something that there are a lot of people concerned about. What does it look like to, what does it look like to control costs? And I think there's a lot of unknowns. So you just have to leave a big buffer and realize, the labor that you have or the people you have for construction, it may not exist in the future at that price. So you've just got to build in some buffers there for sure.
And what's your strategy right now going into this? Like, I think everybody's kind of looking what they're doing, what they thought they were doing wrong. Now I'm like, okay, let's make sure we're changing our strategy of doing things. So, but what's Bronson doing different?
Yeah, absolutely. So what we're doing now is we're continuing to do what we've done. We're continuing to buy, properties. There's kind of two opposing views, right? One is that, oh my gosh, things are uncertain. I'm going to hold back. I'm not going to invest. I'm going to store my cash. And the other one is, I'm just going to put everything into every deal or put as much as I possibly can. I'm probably a little more of the latter, just continuing to put money into deals because I feel like we're getting great properties with great rents, with great upside, with things that we're seeing that we're really excited about. The side of holding on to cash, and I've heard some really, really smart people, even recently at this event I was at in Belize, they were talking about just really having dry powder. And there's a lot of value of having dry powder. If things go on sale, then you get things on sale. But there's a huge cost to carry that dry powder. I was just on a interview before this, and we're talking about the cost of holding cash, at least in the U.S. Again, I'm not familiar on the Canadian rate of inflation, but the official rate in the U.S. is 8.8 or 8.9%, somewhere in that range. But when you count actually rent being 20% growth, which we've had, it's been closer to a 15% or 17% per year. So there's a site called shadowstats.com. Shadowstats.com. They talk about if you use the actual 1980 inflation metrics rather than what they're doing now, where they can kind of fudge these numbers. So if you're just holding cash, it can be really penalized for holding it. So again, I think having a little bit of, having some funds available is good. I think investing in deals and doing deals. The problem is if you just wait for the perfect opportunity. It will never come around. And there's either a time, at least in experience I've been in real estate the last 15 years, there's times where you have lots of deals and no money, like 2008, where there's just deals everywhere, but there's no money, or maybe 2010, 11, or you have lots of money and no deals. And we're still kind of on the tail end of that, where we had a fair amount of money, but there's just no, it's hard to find good deals. Now we're actually seeing things kind of change a little bit, where we're seeing a little more of a balance, where we're finding some pretty great deals. The money is getting a little harder. It was just really easier. It was much easier to raise money maybe a few months ago, but I still think for the right deal, that you can always make something work. And there are some things that are changing where it's becoming a little bit more of a buyer's market in some ways, which is exciting.
Awesome. Are you finding also that, you're talking about the money being harder to find? Are you finding that people are a little bit more scarcity right now? The media are just piling all this BS on us. In Canada, they're saying I think 1 out of 4 houses they're going to have to sell just because of the rising interest rates. And when you take 2 seconds to actually calculate the if you have a variable mortgage, it's not, you're paying more, but it's not that much higher than you were originally.
Yeah, the challenge with the media, Mark Twain had this quote about the news, and of course they didn't have Fox and CNN back then, right, or whatever the channel in Canada is. It's like he said that if you read the news, you're missing. Or no, he said if you don't read the news, you're uninformed, and if you read the news, you're misinformed. So the challenge is you have to temper everything you're hearing. I don't watch the news at all. I'll read some articles, but you always try to temper things through what is the agenda here? Because I think it's something like 90% of the global media is owned by only 9 or 10 different companies. And so there's a lot of narrative that goes out there that's just really just propaganda. We've never really seen, I think, the propaganda kind of like we're seeing it now. And you guys have seen it quite a bit in Canada as well, just from, it's really typically reserved for wartime and other things like that. But it's just so important to think critically, to think for yourself, to be willing to be unpopular, and to really look at things. Again, media is all about fear. It's about creating fear and trying to get you to be afraid. And when that happens, it's important to be aware of. It's important to be aware of when sentiment changes. And I think sentiment has changed a little bit, but I think people don't realize the major risk of inflation. That, if inflation really is 15% or something, you're losing a substantial portion of your wealth if you wait 2 years. And that's just money that you lose, right? You just kiss it goodbye. Let's say it's 15% for the next couple of years, but you're losing over 30% of your wealth just by having it sit in the bank. So I think you have to kind of look at that and just say, okay, what's available right now? What can I get into that's going to help shield me from inflation? And whether rates are high, they're not as high as inflation. I mean, if they go super high, does the investment itself become risky? If you underwrote it at 5% rate, it goes up to 12%, then maybe there's some risks. Are you going to lose the asset or what? I don't think that that's something that really is a serious consideration, but I think that you always have to look at the downside of everything. So I guess what I'm saying is I think investing is great. Maybe having a little bit of money around for rainy day is good, but I think in general I'm putting most of my money out on deals.
Awesome. So when you're talking about borrowing money at a higher rate of interest, are you guys finding it's really changed the dynamic of your deals now that you're underwriting? And are you going, mentioned earlier that you guys are going back, renegotiating the deals, or your outcome, are you guys going to hold them longer, or what's kind of like the play now, on the business cycle? It's not that 5-6 year cycle anymore. You're probably going to stretch it out a little bit.
Well, it's hard to say. We had one that we did in it was March of 2021. It was a 288 unit in Jacksonville. We bought it for $27 million. It's a multifamily deal. $27 million. We planned to hold it 6 years. We ended up selling it 10 months later for $37 million. Right, so we almost doubled the equity just in a very short period of time. I don't know that will happen in the same way going forward. On the other hand, there's for a lot of times, at least in the U.S., there's 2 major types of debt, right? You've got bridge debt, which is typically 2-3 years fixed, and then you have some extendable where you can do a year to 1 to 3 years extendable. You can extend those rates, or there's long-term fixed agency debt, which is like Fannie or Freddie debt, government kind of issued debt. The disadvantages of the government debt is that if you want to sell early, you pay what's called yield maintenance, right? So we've paid millions of dollars to sell some of these deals early. So I think in general, having bridge debt with a interest rate cap on it, we feel pretty good about. And then, I think it just depends. Again, what we really find, we really look for that kind of that value add approach where we can say, hey, rents are $900 or $950 a month. We'll be able to go to $1,500. We feel like the rents will continue to stay solid. Now, if rents came down significantly, or things changed, so the growth stopped happening in a place like Jacksonville or other markets, then we'd have to really watch and just see, is this the type of market or the type of area, the type of deal we want to do. So you do definitely want to look at your downside. You want to understand what the risk of every deal is, or what you think the risk of every deal is. But I think in general, one thing we're doing, we're kind of lowering our expectations on returns. Instead of maybe a 16-17% return projections, we're looking at more of like a 15%. And we're just trying to be more conservative on other levels, because especially when we work with investors, anybody here that does deals or raises money, it's always better to underpromise and overdeliver. So you want to feel like achievably you can, do what you say you're going to do. And everybody understands there's things that are unknown, but I think just being, very conservative on the front side is really helpful, because it allows you to, just prepare for some of those worst case scenarios. So.
Awesome. What, you just came back from Belize. What are the key takeaways you'd say that kind of, opened your eyes and like, oh, you're looking at things a little bit different because, you were there with some pretty big players in the real estate world for the last 9 days. So
yeah, it was interesting. There was, it wasn't a ton of new stuff. There's some really great conversations. Ken McElroy, he's always got some good things to say. The interesting thing is the more real estate or the more assets someone owns or the more wealthy they are, typically the more cautious they will be. I've noticed that, right? So they say that if you're speaking to people that are wealthy, you use that fear, right? That's what the media is. They'll use fear to, here's how you're going to lose what you have, right? And if somebody doesn't have, or speaking to an audience that doesn't have stuff, you sell hope, right? You say, oh, well, you can get this, or you can grow your wealth, or you can do these other things. So I kind of temper everything everybody says, basically just to kind of figure out like, okay, everybody's sharing kind of from their own vantage point. But it was a general consensus. A woman named Danielle DiMartino Booth, who used to work with the Fed in Dallas, was there. A very, very smart lady. Said, yeah, it's pretty clear we're headed into recession. What does that mean for real estate? What does that mean for other asset classes? Her opinion is, yeah, things can slow down a little bit. On the other hand, I personally think, I watched in 2008, 2009 in most markets, rents were still pretty solid. It doesn't mean that they, completely, went way down, but they came down a little bit and then they came right back, and they just kind of, again, followed that trend line I showed at the beginning of this presentation, right? It just generally rises over time. So I think the biggest thing is, in looking at any real estate investment in particular, is just, what will happen if rates rise? Will your caps kick in? For example, we have the interest rate maybe starting out as 4.28%, but as they rise, the highest we can get on that is like 6.5%, right? Because of the interest rate cap that we purchased. And so if it goes higher than that, that's when that insurance kicks in and it covers us in the event that it goes higher. And that's still going to be fine. I mean, obviously we won't make as much money if rates go above that amount, but we feel like it's going to be a matter of time before things come back down. So I think in general, people had different opinions. There was Dr. Chris Martenson was there talking about peak oil, and he was talking about how, he just thinks we just really haven't discovered or drilled or done any new oil discovery in the last 5, 10, 15 years. And so we're just at a place where we're going to be really short. And so some positions in energies could be positive. And if we have a recession, obviously energy use goes down. But everybody has a lot of this. You go to these events and you walk away. Sometimes you're kind of like, well, I heard this and I heard this. And they kind of are a little bit counter. So you have to kind of counter what the other person said. So you have to kind of really, sift out and say, well, what do I want to believe about this? Or what are the things that I wanted to, really follow on that? So
maybe, a lot of people from Canada, they probably never heard the term interest rate cap. You want to just elaborate a little bit more about that? Because I think some people, something that they're not really familiar with.
Yeah. So with multifamily deals, there's two types of debt. Like I mentioned, there's agency, which is long-term fixed debt. So you can get kind of 10-year fixed debt amortized over 25 years at a low rate. The other option is getting bridge debt. And bridge debt is about 85% of the large multifamily in the U.S. is bridge debt. So what it means is it gives you a rate. So the overnight rate, the borrowing rate, the standard, it's called SOFR, which is SOFR. It's an acronym. And basically that's the baseline. So as they raise interest rates by, 0.75 or 75 basis points, it increases that SOFR rate. So that keeps going up higher and higher and higher. So when we get a interest rate cap, it basically is limiting, it's like an insurance that if it goes up higher and faster, then it will start to cover. So meaning, okay, if our interest rate gets above, let's say SOFR plus 4% or something, this will kick in. So again, you have the SOFR side, which is the base rate, plus you have the fee that the lender charges. So those two combine is the total interest rate. So what it just allows us to do is as the rate rises, if it goes above that certain 4% or whatever that amount is, it will just, all that will be covered by the insurance that we're paying for. Now, those premiums for that insurance used to be fairly cheap, and they've gone up 10 to 15 times what they cost, 6 to 12 months ago. So there are people that actually bought those interest rate caps and can actually resell them, and they're making a lot of money on reselling them. So it's funny, it's almost like an options trading strategy or something. But you have to buy the caps because the lender just wants to know that there's some insurance there in case rates go higher, that you're going to be able to cover it, you're going to be able to pay.
And you guys use the interest rate caps on most of your deals, or?
We haven't had to yet. I mean, they're available if we need them. So as rates rise, again, you have insurance just in case you need it. And we expect at some point we may need them, but if we don't need them, we have them. It's almost like insurance on your car or life insurance or something. You hope you don't have to use it, but it's there if you need it. But what it does for us is, even though we're paying a lot more money for the interest rate caps themselves, it's a lot less than if rates went substantially higher, right? It would be harder to weather that for an extended period of time, and that's why we pay to manage the risk of that.
Awesome. What else? Like maybe a lot of Canadians now are starting to look at the U.S. more. Everybody's like, oh, price per door, but maybe from your experience, I don't know if you deal much with Canadians. We kind of briefly talked about it not too long ago, but like, why U.S. multifamily? Why that space? Like, why are you so confident about it? Maybe.
Yeah. So I'm confident about it for a lot of reasons. One is that we did not do a good job building more housing since the Great Recession, since 2008, and we've continued to have population growth. We've had a lot of migration. We're moving to the south, the southeast. A lot of retirees. A lot of people who doesn't love living in Florida or living in a place that's a little warmer, particularly when Canada's in the middle of winter, right? Like you even have a second place to go. So. But I think just the ability to structure in a way that allows you to pay little or no taxes is really advantageous. There's also a shortage of housing in the U.S. There's somewhere around 6.8 million apartment units we're short in the U.S. There's some people would dispute that and say it's closer to 1 or 2 million. I don't know. It's somewhere between. Whatever it is, we're short housing. So, and I think it affects Cleveland a lot different than it affects Jacksonville, right? Cleveland might be a place where population is flat or it's declining, versus a place like Jacksonville. There's so much growth happening. There's not enough room for everybody. That's why rents continue to go up, and why people are continuing to move to these secondary particular markets in Florida and Georgia and Texas and things like that. So I think that's an advantage. Like I mentioned, the taxes, people can defer or not pay any taxes. And then, the fact that you could be a passive investor in a deal, you can help hedge inflation. I think there's just a lot of advantages there. And so again, I used to be an investment advisor for several years, and I just saw behind the curtain at Wall Street. And I just said, Wall Street does not really serve people well. The financial system is really set up with its fees and different things that are there to really try to take advantage. And there's, at least in the U.S., there's a lot of hidden fees that are not disclosed. And I think the biggest thing is being able to get money outside of Wall Street and into Main Street. And I think that that's stuff that media, we've so made it with I don't know how it is in Canada, but the retirement plans, there's something called ERISA, which in the 70s required or allowed employees to do this defined contribution plan rather than a defined benefits. Instead of a pension, it became more of a kind of a long-term, like, here, we're just going to put this amount in here and whatever you have is what you have. It's pushed a lot of money into Wall Street. But I just see a lot of risk there. And I think when you look at going forward, just buying real assets such as real estate, multifamily, self-storage, even real assets such as gold and silver. There's a case for Bitcoin, and for you guys in Canada, I mean, when they started shutting down, people that gave money to the Canadian truckers, I mean, that to me is just kind of like, and we're seeing in the US as well, that anybody's I'm not a fan of what's happening in Russia at all, but they're shutting down anybody who's associated just even loosely with Russia. I just think it's interesting that, you know, we have this financial system, and if it's in the system, it's not always accessible, right? It's not always accessible to you. So when you're more in Main Street, investing in Main Street, I feel like it's something that impacts people in a much different way than doing something on Wall Street or more of a larger financial asset category such as that.
And part of your strategy when you're looking at, you know, taxes and stuff, are you guys using like opportunity zones, some of the stuff you guys are doing, or other things?
Opportunity zone. It's an interesting strategy. We haven't done really any of it. It requires typically to get the full advantage. It requires a 10-year hold, and it's really good for certain institutional investments that, you know, hold for 10 years. A lot of our investors, they want to get their money back in 5 years, and so when you start talking about over 5 years, or, you know, they think, man, I'm going to be old when I get this back, or how long is this going to be? So, but you know, there are some unique areas you can invest in and get some advantages that way. You know, we just really look for the areas where we find population growth, job growth, and income growth, and where we find very few limitations of, you know, no rent controls. It's a business-friendly place. It's landlord-friendly. If people don't pay, you can get them out. You know, in Los Angeles, the city of Los Angeles, I live in the LA area, but in the city of LA, they passed real recently that the eviction moratorium will extend all the way to June of 2023. And so that's, you know, a year from now. And UCLA recently did a study, and they found that 50% of the tenants that are renting in the city of LA have stopped paying rent. So this is a problem, right? There's no, and again, if you're own a small house or a small multifamily in LA City, you're dying because the relief has stopped, right? And you can't get rid of people that have stopped paying, even if they're buying new cars or they're working, or they can just say, oh, it's COVID. And now, so this is a real challenge. So we buy in areas where we see they are very landlord friendly, that if someone stops paying or someone, you know, is a problem tenant, you can get rid of them. You can find a way to, you know, get them out and get somebody in there who's going to, you know, care for the place, or gonna, you know, they're gonna pay rent. So, so that, I guess those are the things that we like, but we do try to target the areas where we see a lot of population growth.
Awesome. I don't know if anybody wants to kind of hop on or ask questions. Bronson's very knowledgeable about the U.S. real estate market, more than me. If you guys want to pick his brain, it's your opportunity to pick his brain. If you want to unmute yourself, feel free to unmute yourself. I'm sure Johnson's going to have some questions.
Yeah, I mean, Johnson's part of Thing Multifamily, which is a great group of people. So love that.
Yeah, no, I don't have any questions. I'm just, I resonate with everything you said there, Bronson. I'm still very bullish in multifamily. And a lot of kind of savvy entrepreneurs, they're thinking about ways to preserve their capital, and, you know, what other places would they put their money? Definitely not crypto, not stock markets, but multifamily has proven itself to be pretty resilient. So running into that as well.
Yeah, I think that's a good point. I think that, you know, multifamily is, I think as an investor, we need to look at, you know, what are we trying to achieve by investing in anything, right? What are the things we're looking for? Well, I'm looking for good returns. I'm looking for a tax advantage strategy. I'm looking for, you know, just stability of the asset class. We have an ATM machine fund that we do now with the 5th largest operator of ATMs in the country, which we just closed it, but we had it open for a few weeks, and we had about 2.5 times the interest that I expected to get in it, right? So I think people are finding different things to put money into. And I think, you know, there's self-storage, there's mobile home parks, there's all types of things. But in general, we can wait a little while and hold cash. But I think, you know, I know people have been holding cash for like 10 years. And I'm like, you know, it's time to, like, sometimes analysis paralysis is real, you know. So I think getting in the game is really important.
Awesome.
Hey, Bronson.
Hey, Ludi, how you doing?
Good. It was nice seeing you in Dallas, and thank you so much for coming today.
That was great, man. It was great seeing you there and hanging out with you and Mathieu. And yeah, it looks like you're in the car there. Looks like you're on your way out to go experience some of the sun here and enjoy.
Yeah, pick up my from the airport. I have a quick question. How do you see now, I mean, you know, the multifamily space impacted with the rising interest rates? Do you see like opportunities that more properties will be on the market and prices will adjust accordingly? Like, what is your vision for the next, 6 to 8 months? Yeah.
Yeah, I mean, I think no one knows. I'll just say that at the start, no one knows. I think it really depends on how long and how aggressively they raise rates, because for them to raise, at least in the U.S., by raising 0.75% or 75 basis points every single month, well, you can only do that so many months before, you're really significantly raising the base rate, right? So I almost wonder if they're going to raise them pretty quickly here, and then something may break, and then they start to reverse course, or they hold off, or something else. But the challenge is, the price of money is really determined by where inflation is, or not inflation, where the interest rate is. So if the interest rate is zero, then it's easy money everywhere. Everybody's got my money's just very available, credits everywhere. If interest rate is high, then money becomes more valuable, right? Because or at least cash becomes more. So it's kind of this both and thing. I think the next 6 to 12 months, my thought is that the Fed will keep raising rates, and then they will pause or reverse course, because they'll realize that it's unmanageable, both from a debt standpoint in the U.S., just as far as the federal debt, and it causes whatever industry it is, something will break, and they'll have to come into the rescue. And I think they'll bring rates back down. I don't know if they'll bring them to zero, but they might. And I think the problem is we've just become so addicted to easy money that I think that they're going to go back to it. And that's my opinion.
Awesome. Oh, Ludi, I muted you by accident because there's too much echo, because we're recording it. You have to unmute yourself. Sorry.
No, I just said makes sense, and thank you very much.
Sure. Thanks, Ludi.
Anybody else have question in? Ian usually likes to talk a lot, but he's shy tonight. So.
Sure.
Oh, I'm here. Yeah. No, I appreciate this. Thanks very much for the invite. Yeah, it's been great. I'm more into, I haven't broken into the multifamily yet, but it's definitely could be on the horizon. I'm more into the residential in Edmonton at this moment. So just trying to purchase as much as I can over the next couple of years here, while everything's still on sale in that area. It's going up quickly. I have a couple of houses there that have appreciated $200K in the last 3 years.
Amazing.
There were new builds that, I built those for $542, and they could be listed for $750 now. So things are on the rise in that area for sure. Pretty exciting stuff. Yeah,
it is interesting to see. That's the whole thing is we just don't know. I think there could be, I think that long term we're going to continue to have inflation. I think there could be some short term where, we do have if there's a recession, maybe some single family comes down in value for a little bit. Maybe some multifamily comes down for a little bit, but it doesn't mean that they're not good investments. That especially, and I don't know if you guys do, I don't think you guys do the same kind of debt that maybe you do, but the 30-year fixed mortgage. I've had friends that say, when you own a 30-year mortgage on a house and it's 5% or less, the value really and the asset is it's not really the house, it's the loan, right? Because in fact, you got this debt for so cheap that we know in the future, inflation will probably be higher, that rates will probably be higher, but you've got such a low rate on it. So I think that's something to really consider. But I think that, in general, we're not, especially starter or kind of regular homes, they're not really building, at least in the U.S., kind of regular kind of starter homes. They're all these luxury type of homes, and we're short on so many homes. So I think housing in general is going to be a good place to be. It's just yet to be seen kind of what that process will look like as we go through higher rates, and if they stay high or if they come down. And but no, I think owning is awesome.
What's your opinion? Maybe one question on the age-old question about variable versus fixed. At this point.
Yeah, so we were talking about it a little bit earlier. I have friends and we've also paid as well when you have a fixed rate debt, particularly I'm going to speak on multifamily. I think on a single family in the U.S., if you can have a fixed rate 30-year, or even if you have a little higher rate, I think it's better, substantially better, because you got a low rate for a long period of time. The other side of that is if you have like on the multifamily, you have the bridge debt or you have the or more of a fixed agency debt, but they have penalties if you sell before 5 years typically. And we've paid out millions of dollars to sell early, and it still made sense because of valuations to sell. So I think when it comes to multifamily, about 85% of debt right now in large multifamily is bridge or variable debt. And I think that, it's shorter term debt. And I think in general, it typically makes sense. I was just on a panel recently. I had a couple guys in and saying about 80, almost 90% of the time, 89% of the time, I think it was, variable kind of bridge debt made more sense historically. So it's a rare time. It could happen, but and this guy was just saying, he's like, I paid out over tens of millions of dollars in fees to sell early on fixed debt. So some of that, and it still made sense to sell it. So I think that you kind of have to try to figure out and learn. I mean, I think there's advantages, but the disadvantage of fixed long-term agency debt right now is that typically it's a different loan to value. So the deal, you have to raise a lot more money. Obviously it's fixed, so you do have the risk of the yield maintenance payments or payment if you have to sell early.
Oh, I see. Okay.
Yeah.
Okay. Well, great. Yeah. Very interesting stuff. Thanks again for the invite.
Oh, for sure.
It's been
nice
awesome. You too.
Anybody else have more questions before we wrap it up tonight? Don't be shy. Oh, somebody's coming on.
Bronson,
Yes.
what's the next deal that you're working on?
Well, we got 3 under contract right now. We got one that actually opens tomorrow. That's a Jacksonville deal, and we're pretty excited about it. So another value add multifamily kind of deal. So yeah, that's the next one. 227 units, a C+ property in Jacksonville. So I'm excited.
Do you want to talk about it a bit or no?
Sure, I can talk about it. This one we can talk about. A lot of them we can't in the U.S. There's certain limits. This one's for accredited investors only, so a certain net worth. And but yeah, basically it's 227 units, built 1973, and the average rents are about $922, and we're seeing current going rate for renovated units about $1,500. So quite a bit of upside in the rents, which we love. And I guess we feel like we'll get some pretty decent debt on it, and we're excited about it. I think it's a $12 million raise. So my partners and I are putting that together, and we're pretty excited about it.
Awesome! Congrats.
Yeah. Maybe I can find
Congratulations.
What's that?
Oh, I said congratulations.
Oh, thank you. Yeah, maybe I can find the link and put it in the chat for anybody who wants to take a look at it so you can see it. Well,
if you guys want to connect also with Bronson, I put his contact info in his YouTube channel in the chat, so feel free to connect with him. He's definitely active on social media, so you'll see lots of stuff going on there too.
Yeah, so I put that in the chat there too. So if anyone wants to take a look at that specific deal, they can.
Awesome. All right, guys. Well, thanks again, everybody, for joining, and we'll see you at the next event. Thanks again, Bronson, for coming. Always a pleasure speaking with you.
Matt, thanks for having me. Thanks for everybody. And if anyone wants to reach out about passive or active real estate or any topics, I'd love to connect. So feel free to reach out.
Awesome. Take care,
Thank you so
everybody.
much for your